Let me go back to Tim Anderson right now. Charlie says this is just a big puke fest, and sometimes the market needs that.
Certainly, and it's almost like a little bit of a cleansing process.
That's a nicer way of saying it, Tim. I appreciate you're classing up the place.
And we've definitely seen some selling in some of the very high PE stocks, some of the stocks that might have gotten ahead of themselves on both a valuation and a price basis. It's a little bit of a valuation correction with some of that money going into the banks, which have been underperforming for most of the year. I noticed Square is a stock that was down 10% yesterday. It trades at about 100 PE. Amazon is off quite a bit today. Obviously a very high PE stock, although also a very high growth stock. But sometimes when you get the beginning of a sharp sell-off, or you get a sharp 2 or 3 or 4 day correction, it's always the high beta and the high PE stocks that take the brunt of it.
Yeah, I mean, that makes sense.
Also, what's really working against the market today is that oil is down, which we haven't seen too many times in the last 3 weeks. Yeah. The commodity's down about $1.50, and there's a lot of profit taking in the oil sector.
What do you think is going on in oil? Is that, again, a bet on perhaps David Nelson, less of a growth story in our economy and in the world economy?
Certainly, if there's a concern about slower global growth, the sharp rally in oil is going to take a breather.
Let me throw that one for a moment there at David Nelson. What do you think?
Sure. On oil, right now, I'm not that concerned about oil, and I think oil will kind of tame out. For each dollar that it goes higher, another well comes back online here. So I don't think it's going to drag down the economy. I think the one thing to be concerned about is world markets, especially emerging markets, have been in a funk for a pretty long time. China's 33% of emerging markets right now. They're well in bear market territory. In the end, these emerging economies and even the developed economies, they are our customers. 40% of S&P revenue is offshore. So it's an issue. It's something we have to think about, on a day-to-day basis.
Okay, so now we get back to, can we decouple from the emerging? I know Charlie likes that. Remember that when that was all the rage when we used to talk about coupling, decoupling, and I guess the question is,
back in 2008, would the markets decouple from the banking once the banks get better?
But the question is now with emerging markets, can we decouple enough? I mean, David's making the valid point that 40% of earnings in the S&P comes from emerging market countries. So how dependent are we on them, and vice versa?
Well, we are to some extent. We should also point out that tariffs and stuff like that does not help that scenario. You know what I'm saying? They buy our stuff, and if we're in some sort of retaliatory thing with them, even if it's on the margins, it's going to be marginally negative for the economy. I would just get back to this. I mean, listen. The Trump economy is an amazing thing. It's a mishmash.
Wait. Did I hear Charlie say that? The Trump economy is an amazing thing.
But it's not.
It's not
necessarily.
This is not a positive thing.
No,
you got a negative
it's not necessarily amazingly good. It's a schizophrenic, partially free market, partially tariffs. Now marginally higher interest rates after he said he wanted much low. We thought we were going to get a Fed chair that would be more of a dove, more like Janet Yellen, but
Trump is not happy with the higher rates.
He's not happy, and he's not the only president that hasn't been happy with higher rates. So this is an economy that is dealing with a lot of different cross currents. I will just say this though: if you're the average investor, what is the bottom line thing you look at? You look at corporate earnings, right? Corporate earnings are pretty good. Yeah. Right? And now the question, do we get...
expected, if you believe Adam, getting even better.
21% is the expectation for the quarter that starts getting reported later this week.
That is really good. And the question is, can we keep that going? And is there any other headwinds? There are headwinds out there. I am telling you. And I don't
one of those headwinds, according to Gary Kaltbaum, is debt. But other things you're looking at?
Now, why is it debt? Now, think about it. He makes a great point. And Gary, you'll agree with me on this. Why is it debt? Because if we don't grow by accumulating so much debt with a massive corporate tax cut, if we don't grow the economy long enough to pay back that debt, like we don't have 4% GDP prints for a while, guess what? You're going to have higher interest rates. And then that's a huge problem. And I think Gary would agree with that.
simply put, the cost of everything goes up.
Right.
It's not just the federal debt. It's credit cards, it's student loans, it's car loans, it's mortgages. By the way, on the mortgage front, just a $200,000 mortgage is about an extra $40,000 in interest over the life. That is money coming out of the pocket. Add in the energy also at this point in time. And I'm telling you, we may start to see some guidance from corporations because of higher energy prices, because of higher interest rates, add in the tariffs, that they're going to have to start lowering numbers. And I'm not meaning to be a Cassandra here, but I deal with reality, and I've studied markets and economies for 100 years. This is meaningful.
You look 100 years old there, Gary.
Yeah, well, I went backwards. But my point is, markets are a forward-looking thing, and I think there's a potential here for that right now.
You're putting some credence into this. I'm going to bring Adam back into the conversation because, Adam, you don't buy it.
No, I really don't buy it. Rates are still very close to historic lows. I mean, we're only about 100 basis points from the all-time lows. So, you know what, if we got accustomed, as Gary pointed out, to, paying a mortgage rate that now costs $40,000 more of the course of loan, that was the lowest it ever was, ever. So it should be higher. I'm okay with that. As far as, oil going up, the fact is, there is so much oil in the world right now. Saudi Arabia, Russia, and the U.S. are pumping more than 11 million barrels a day. There's so much oil in West Texas that they can't even fill, or they can't get into the pipelines. It's backing up. It trades at an $18 discount to the futures, which are only 300 miles away.
But
all right. I want to go back to Tim on the floor.
We're getting carried away with all this worrying about interest rates and oil.
I guess if you're a bull in this environment, that you're out there, Tim, you're buying. Gary's a little more nervous. He's going to sit on the sidelines. But, Tim, what are you hearing from people? If this continues for another day, would you be stepping in?
Yes, and I'm a little bit more with Adam than I am with Gary on this because I think that we're really just maybe 3 days into a really sharp sell-off here. This is clearly the sharpest sell-off we've had. And I wouldn't be terribly surprised to see another half a day, a full day of this. Earnings start on Friday. It's very typical for big institutions to sell in advance of an earnings season. And it's also really works in their favor that this big sell-off is happening so early in the quarter. I mean, it's October 10th. They just had a great third quarter. They have more than 2.5 months to deal with this before their fourth quarter performance numbers. And you could very likely see some vicious sector rotation. But I really don't think that the really big managers are going to panic through this scenario because there's so much time left in the quarter for them to deal with this.